Last Monday, Euro confirmed short with the 11:15 a.m. candle in its regular trading hours. What would you do in that situation? Would you know where and when to enter and exit your position with a high probability, or would you rather guess and pray that you're not getting stopped out? If option 2 is you, then it's time to step your trading up and stop the guesswork. For this demonstration, we are focusing on what the algo has done in the past 18 years if the short confirmation happened in that strict time window. A short confirmation on Euro's Monday regular DR session between 11 to 11:30 a.m. has an 84% probability to turn into a true session and not close above the defining range on a 5-minute time frame. A DR upside model across all 3 DR sessions is being intact, which means that the overnight DR session lows can become a sensitive level as it's holding the structure for a DR upside model continuation. With that being said, we have to adapt to historical data and see what past occurrences would suggest in this situation. Since we ideally want the DR session not to close above the defining range, we will focus on the data for the 84% true sessions. A retracement back into the defining range happened 80% of the time, while it retraced back into the implied defining range significantly lower, 67.3% of the time. So when and where did price retrace back into the defining range most frequently over the past 18 years? Let's find out. The maximum retracement for the session, if it held true, happened 50% of the time until 11:30 a.m., and the rest of retracements happened after that time until the session ends at 4 p.m. So after a short confirmation in that time window, expect a quick retracement before continuation. Everything right after a long confirmation between 11 to 11:30 a.m. is considered as your entry time window up until the session ends. Let's have a look at all maximum retracements for a DR true session. Where exactly should you look for an entry in the defining range? Data shows that most maximum retracements back into the defining range happened in the plus 0.19 to 0 area. The distribution is crystal clear. Looks like the algo loves to have a shallow retracement back into the defining range and continue to the downside. The 0 level or IDR low marks the 70 percentile, which means that only 30% historically retraced higher than that in a DR true session. Since the plus 0.19 level is most likely outside the defining range, you reduce this zone to the plus 0.09 level and can include minus 0.1 as well, as you would then cover more than 70% of historical maximum retracements with your stop loss. In this session, you would also cover an intraday gap imbalance from the previous day's aftermarket DR session. You should already know how important aftermarket DR session gap imbalances are for price. A second bullet, if stopped out on the first one, can be taken in the minus 0.4 to minus 0.6 area. Do you notice how the algo has never had its maximum retracement in the minus 0.6 to minus 0.8 area? Looks like a perfect spot for your stop loss, huh? For the second bullet, therefore, you can set your stop loss 3 ticks above the minus 0.6 retracement level. With that stop loss, you're covering around 90% of historical maximum retracements that happened in a DR true session. That's crazy when you think about it. Apply these 2 areas for a potential entry throughout the session. If a short confirmation happens between 11 and 11:30 a.m. in Monday's regular trading hours. Join me as I teach thousands of students how to trade like a professional. Learn how to trade the DR trading strategy combined with data, get access to exclusive tools and indicators, weekly live trading sessions where you also get deep market insights, which have never been taught in the retail space before, and a lot more. Visit m7dr.com for more information. Last but not least, let's have a look at where price extended to most frequently. 70% historically, price extended towards 0.8 to 0.89 standard deviations during a true session. If we select the time for a maximum retracement after 11:30 a.m., we can see that price even extended to the 1 standard deviation level quite frequently. What does that mean for us? If the maximum retracement happens up until 11:30 a.m., the likelihood of reaching 0.8 to 0.89 standard deviations increases. So, if you enter before 11:30 a.m., you can aim for the target of 0.8 to 0.89 standard deviations, while with an entry after 11:30 a.m., you can even go for the 1 standard deviation level as a target. Last but not least, all positions, whether slightly in profit or loss, should be closed with the 3:55 p.m. candle, since this candle ends at 4 p.m. and therefore also the regular DR session. This trade right here would have been tagged immediately, and the target of 0.8 to 0.89 standard deviations lines up exactly with the overnight DR session lows, which in this constellation are vital for the DR upside model to continue. What can I say? Absolutely beautiful. Later in the session, price even extended further than 1 standard deviation. And there you have it. Now you have a setup that you can repeatedly execute on whenever Euro FX futures confirm shorts in Monday's regular trading hours between 11 to 11:30 a.m. You know exactly what to expect, where to execute, and where to exit your position based on time and price. I guarantee you that there's way more amazing insights and powerful information to the DR trading strategy. And what I share on YouTube is like 5% of it. If you really want to dive deeper into data and statistics, as well as algorithmic price behavior, and create your own playbook with daily high probability trade setups backed by data, then feel free to visit M7DR.com. Have a good trading week, and I hope to see you in the next video. We're gonna take on the world.